I'm here with Scott Bennett, Director of Factor Investing and Multi-Asset at Invesco. Scott, thanks for speaking at the Equities and Growth Assets Symposium.
Thanks, Tahn. Pleasure to be here.
The tagline of the event is Sailing Through Headwinds. In your opinion, how should advisors try to achieve this?
Yeah, I think in our opinion, the headwinds have actually turned into tailwinds for a lot of investors over the course of 2023 into the start of 2024. So where we're starting 2024 is quite a different landscape than where we were at the start of 2023. So a lot of those headwinds regarding high inflation, rising interest rates have now turned into tailwinds in terms of relatively low inflation, still solid economic growth, and much more dovish sentiment towards interest rates. And that's actually proving to be a big tailwind for risky assets as a whole.
Yeah. And you focus on factor-based principles. How would you capture your approach to building a portfolio?
Yeah, so we consider ourselves factor investors, but at the end of the day, we're really just foundational, fundamental investors. So we target factors like value, momentum, and quality. But essentially what we're really looking for is above average quality companies trading on relatively low valuations that have a solid earnings profile. And it doesn't get more fundamental than that. So in the whole, we're using factors to target high-quality companies on low valuations with solid earnings. And history has shown that those companies do very, very well.
One of the trends of recent years has been the vigilance advice practices pay towards fee budgets for clients, Scott. Will this remain the case in years to come, or will new market forces dictate a change?
I think fees are always going to be an issue for advisors and their clients. And especially in more esoteric asset classes, if we think about things like Australian small caps. So the average fee for an Australian small cap equity manager is about 1.6%. And that eats up over close to a third to half of the overall active returns that are generated in that market. And we think that there's going to be more democratization of fees, and we believe that fees will be coming down. And advisors and investors should look to get rewarded for the fees they pay.
And some advisors have looked beyond small caps to complement their core equities holdings. What are the top 3 reasons they should rethink this?
Well, we think there's a massive amount of growth opportunity in small caps. We think we're entering an interest rate cycle that's very, very favourable for small caps. And we also think there's significant diversification benefits through a small cap equity allocation. And in addition to that, the power of active management in small caps, especially within Australian small caps, is the biggest opportunity within global markets. So the level of active return available for Australian investors in Aussie small caps is the highest in any other part of the equity market. So we think that advisors would be doing themselves a disservice by looking beyond the returns that are available in Australian small caps at the moment.
It certainly feels like the market's swinging that way. What do you think could be the biggest surprise for markets in 2024?
I think the biggest surprise for markets is this notion of a soft landing. So when we think about markets, everyone's looking at, well, we haven't had the recession that we were meant to have and maybe hanging off till there's more bad news. But when we look at it, we think that markets have actually right in the sweet spot of that recovery phase. And that really favors more growth-oriented assets and really favors investors that are willing to take on more risk. So the biggest opportunity we see is actually increased risk-taking from investors to take advantage of those structural tailwinds that were mentioned earlier.
Interesting times. Scott Bennett, thanks for joining us.
Thanks, Tahn. Pleasure.